Hello and welcome back to the channel. Today I want to talk to you guys about internal liquidity to external liquidity. Internal liquidity is going to be fair value gaps and order blocks, okay? And external liquidity is going to be swing highs and swing lows to simplify the strategy. And today we are looking at a very clean internal to external trade. In this example, the market drives higher and then pulls back into an old buy side inefficiency, sell side imbalance, which is going to be our internal liquidity, okay? Because it's internal of the move up. So we're inside of this leg, and now what we're going to do is we're going to target external liquidity. When you guys are able to identify this setup and these models, it makes things so much easier to simplify your trading. Instead of just trading blind, you're now saying, okay, I get it. We're in an internal fair value gap. I have external liquidity resting up here, which is London highs. I want to now find a trade setup on the lower time frames where I can trade along into London highs. Okay. So the first step is identifying that, hey, is this an internal to external move? In this example, that's what we're going to trade off of. So the 1 hour time frame pulls back into a 1 hour fair value gap. Okay. And now we drop down onto the lower time frames to try to find a model that will draw back up into London highs, right? It's very, very simple. You wait for an internal liquidity point to be formed, which in this example, like I said, is this 1 hour gap. So you'd wait for this gap to be formed. Like we're drawing higher, right? But we're not FOMOing in just yet into this trade. We're waiting for that old gap to get retested so we can go higher into a liquidity point that's still untagged as our external liquidity, okay? Now, back to the 5-minute time frame, because this is where we're going to get our setup. Market pulls into the 1 hour gap. Okay. And now we start formulating a plan. My models include breaker blocks, unicorns, and fair value gaps, and inverted fair value gaps. We're going to wait for something to set up on the lower time frame. Okay. So the market is starting to show signs that it wants to reverse. We're getting a very nice V-shaped recovery here. We're always looking for a V-shaped recovery at a major PD array, which is that 1 hour internal fair value gap, which is a 1 hour PD array. Okay. When I say PD arrays, those are going to be fair value gaps of some sort. Okay. So in this example, market pulls into it, right? The market sweeps this low down here, which is going to be our money sweep. I always mark it as money. That's going to be our liquidity sweep. Okay. So the market takes people's orders here. Because if you think about it, right, so anybody that got long here just got stopped out here, right? They probably had their stops at the low. Market takes those orders. Okay. The first smaller clue that we're going to reverse is this 1 minute FEG that turns into a 1 minute inverted fair value gap. So that's clue number one. Liquidity sweep, inverted fair value gap. Now it's like, okay, the market's looking great. V-shaped recovery, inverted fair value gap. Things are starting to look pretty decent. Now, once this market takes this swing high here, that is what we call a change in the state of delivery. Okay, the market now is starting to deliver in the opposite direction. We get the nice V-shaped recovery. Market's starting to show signs that we want to go higher. Now, with that change in the state of delivery, we also have a breaker block, which is sitting right here. Okay. If you guys know anything about breaker blocks here on the channel, they're pretty simple to identify. They happen at major swing high or swing low points. In this example, we're using this PD array as the major swing low. We get a low, a high, a lower low, and a new higher high. That confirms the breaker block and the change in the state of delivery. Now, we use, in this example, the two highest up close candles before the leg down that took our liquidity. So we use the two highest up close candles as our breaker block. We use the body of the candles. Okay. The body of the candles. Now, if we look higher, okay, and I'm going to bring this in so we can see this a little clearer. The London highs are still left untagged. So London highs at 2:15 a.m. in the morning And this market is now, we're at 7 a.m. before the market open. We're looking for London highs. Okay. So we get a very clean 5-minute breaker / unicorn setup here. The reason it's a unicorn is because inside of the breaker, there is a fair value gap. Okay. Whenever there's a unicorn, and a fair value gap inside of a breaker, it makes it a unicorn breaker. It's a higher probability breaker model. Okay. Now, how do we get an entry? Well, you're going to wait until you get a pullback into that fair value gap. That's the first step to the puzzle, first piece to the puzzle. Market's going to go ahead and pull back in right there. On this wick, you're going to be filled. It's not going to give me an option to do that because the trading replay thing is a little funky. But on that wick here into this breaker, that's going to be your fill. Stop loss is going to be below the breaker. So we're risking 345 on this one mini trade. And we're always targeting at least a 1 to 2 RR. That's going to be the first area that we're going to look to target. So it's going to be 1 to 2 RR. Okay. Which is going to be here. Now, that could be used as TP1 in this example, or that could also be used as an area to take full take profit. Now, if you're using it as TP1, that means you're likely trading multiple contracts and you can take something off the table at this 1 to 2 RR here. Okay, in this example, I'm going to target London high because it's a clear draw on liquidity for me. It's an internal to external move, and I really like the London highs here, and I want to hold for longer, right? And I'm looking to take really nice trades that are going to net me a high reward. So I'm low risk, high reward. I'm risking 345 to make almost $1,800. Okay. So after we identify all of this, right, and we piece all this together in our model, all we have to do at this point, guys, is execute the trade and sit back and let the market do the rest. Okay. And I'm just going to press play here and we're just going to watch how this trade ends up playing out. Okay. And as the trade is moving higher, I'm going to tell you how I would manage the trade as well, because that is a big part about trading. Okay. Is managing the trade. So right here at the 1 to 2 mark, which I wanted to talk to you guys about first. Let me get back up here. Boom. Okay. So at 1 to 2 right here, it is appropriate to close the trade full. Okay. We basically have netted around $600 here. We risked 345. Closing full here is totally appropriate. If you have multiple contracts on, you can take, in this example, let's just say if you have 2 contracts, you could take 1 contract off here, okay? And then move stops to break even at this point. So now this trade is completely risk-free and you've already locked in profit. Now, that last contract, you want to hold for more, okay? So you can then, just target the London high. Now, at this point, you've already locked in 1 contract of profit. You're risk-free on the trade, and you still have 1 runner going to your overall draw on liquidity to maximize your trade setup. Okay. So we just let this trade at this point. All you have to do, guys, is let the trade do its thing. Let the trade run. Okay. Not get scared about pullbacks, because again, we don't care what happens here. We're already risk-free. We've already taken 1 contract off, and we're going to let this trade run to full TP without micromanaging it, because we want to let our runners and our winners trade as long as they can. And we want to cut our losers as quick as we can. Okay. So guys, that is the model. It's very simple to identify. On the higher time frame, it's very simple to look at. Okay. All you're looking for is an internal liquidity pool, which is going to be the 1 hour fair value gap. You're going to look for a lower time frame model. Okay. And then you're going to look to target your external liquidity, which in this example is going to be the London highs. If you guys are able to simplify your trading like this, it's going to make your lives a lot easier, because when you have guidance like we do here, right? And we have a clear target and we have a clear internal liquidity that we took already, it's going to make the visual picture a lot easier for you guys to understand. If you don't have these tools in your arsenal, essentially you're trading blind and you're kind of doing a lot of guessing work. With this strategy here of what I've just taught you, you're taking the guesswork out of it, okay? You know that my model tells me, hey, internal liquidity was taken, V-shaped recovery, inverted fair value gap, change in the state of delivery, breaker block, unicorn inside the breaker, clear and concise draw on liquidity higher. I execute my model with peace of mind and I let the market do the rest. Guys, this model right here has changed my life and many other people's lives. If you guys can learn it, it'll also change your life. If you guys enjoyed this content, please do me a favor, subscribe, like the video, and I'll see you guys in the next one.